Equity markets finally roll over post options expiry as COVID fears return. Oil drops 8% in a day, the biggest drop this year, and bond yields continue breaking down, shifting focus away from lower inflation to weaker growth. All this and more in this week's Macro Insight. Okay, so welcome back to Macro Insight, everyone. Good to have you here. Today is the 20th of July, and also welcome to any new subscribers, any free trialers. You know, it's great to have you as part of the community. So what's been going on? Last week, obviously, all eyes were on the CPI. It kind of came out as we were having this call last week, so we didn't really get a chance to see how the market was digesting it. But, you know, as things transpired, it beat expectations. Again, you know, used car prices pretty high. They seem to be the dominant driver of these numbers at the minute. Signaling, you know, inflation might not be as transitory as some have been saying. Jury's still out on that, I think. But, you know, after an initial knee-jerk reaction higher in yields and in the yield curve going a bit steeper, the bond market gave up the entire move in short order and yields broke to the downside. So, I think clearly concerns on growth there with or without inflation, right? So the bond market is telling us growth is the problem here. You might get stagflation, you might get deflation, but really the predominant issue here is growth looks like it's peaked, right? And that seems to be really what's been in the limelight. Now, according to JP Morgan, you know, they've got their various models. They're looking at this decline in treasury yields, saying that, you know, this decline in yield would be justified if we lowered our growth expectations by about 3% for the year, for over the next year, right? So that's how they're kind of seeing this move, if they're trying to calibrate their models on what this move is trying to say about growth. You know? Let me share my screen. So here we've got the yield move. You can see CPI print. We went from kind of lows of 125, popped up to 142 briefly, and then smashed straight back down into sort of new local lows. And, you know, getting worse over the weekend, obviously a dramatic drop over the weekend. And now we're down to 115, levels we haven't seen for quite some time since sort of February. Yeah. If we look at the sort of stock market, obviously the S&P, slightly different picture last week, where we had, you know, we'd been flagging the kind of gamma that was pinning the market, right? So if I bring up the hourly chart, you can see here, you had pretty much from the 13th of July all the way up to Friday expiry, which was the open on Friday. We were stuck in this range of about 1.25% between 43.40 and 4,400. Okay, and that was due to the street being quite long gamma. And we know that has a kind of compression effect on vol as dealers do their gamma hedging, basically, right? And, you know, funnily enough, as soon as that expires, within a few hours, the sell-off takes hold. You know, everything that's going on in the bond market and the general sort of macro risk asset space drags the market lower, basically. We got a proper move out of that range down to lows of 42.33 yesterday. Now, obviously, I follow the guys at Spot Gamma quite closely. They were calling for that level down there at 42.40. Now, it happened to coincide with the 50-day moving average. But also, if you look at the gamma landscape of the options on the S&P, there was a bit of kind of, you know, an interesting sort of part in the structure of that landscape around that level. That was why they signaled that as the first potential support area. And it was pretty damn good, right? We got to lows, they said 42.40. We got to lows of 33 and stayed a pretty decent bounce, right? So, you know, that bounce has got us back up to, you know, 42.90 was the kind of high. We're now sitting at around 42.75. Personally, I'm looking at 4,300 as a local kind of top to this sort of bounce. You know, I don't think the selling's done yet. I think we're in a short gamma territory now because that July optionality is rolled off. So the market will need a bit of time to replenish that position as more vol selling comes in. But right now, we're still in a relatively precarious spot, in my opinion. If you look at what the VIX did as well, obviously, massive spike on the VIX. Better to kind of look at this chart, I think. You know, pretty much spiked to where you would expect it, right? If we look at these spikes, you know, going back to kind of last year, that those spikes are getting smaller and smaller, but, you know, it kind of did minimum that it needed to do, spiking to like 25, if you think this kind of structure's in place. I don't know. I mean, I still think the macro landscape's a bit precarious. I wouldn't be surprised to see a break towards maybe 30 on the VIX before this is kind of ultimately resolved. But something to keep an eye on. Obviously, we'd been flagging that the VIX had been making a base around that 16 area, despite the market making new highs. And that was often a signal that you should be a little bit on lookout and on watch for a sell-off. And lo and behold, we did get a sell-off, right? So now, you know, would I be rushing to buy VIX here at these levels? Little bit kind of hard to make that call, I would say. You know, I'd probably use strength in the S&P to maybe justify putting on, you know, put spreads and things like that if you're caught a little bit long this market and you didn't manage to get out of any exposures or do any stock replacement trades like we've been flagging the previous couple of weeks. You know, if you are looking to add shorts, you know, you might get a chance today towards 4,300 to put on those type of trades. Bit hard to buy the VIX here, I think, to be honest. Yeah. On that note, you know, the VIX curve obviously flattened massively. You know, if we bring up, let me just share screen here, bring up a few visuals on that. So here you got the kind of term structure on the VIX. It had gone very steep contango with July around sort of 18 and a bit, August a bit higher. Now the whole thing's kind of flat around 23-ish. Obviously, that tends to happen when vol spikes. So, you know, if things do normalize, that front end has got room to come in. But we had been flagging that August VIX contract, which is going to become the front month after Wednesday, because July is rolling off, that August VIX contract does contain the time window that contains Jackson Hole. So, you know, even though it's at 23, I don't know, it may well find a bit of a floor closer to sort of 18 to 20 range, rather than heading straight back to 16 like we have been seeing over the last couple of months, right? So that's kind of where I'm seeing that. An interesting note from Spot Gamma. They're kind of tracking some of this sort of small activity, you know, small trader activity. They put this chart out, right? So this shows selling option premium, okay? So small lots, retail trades, and saying that, you know, whereas historically, you know, retail guys have been buying calls, after a few months of burning premium in calls, they thought they'd try selling puts as a way of getting long this market. and that doesn't seem to have gone overly well for them, right? So some of the vol spike, some of the panic selling we saw may well have been, you know, people scrambling to cover or getting margin called on short put positions, like in the retail space. That may have fueled that big spike as well, right? So just something to be aware of. But I mean, in general, the kind of surge in Delta variant of the virus cases has been blamed for this broad market weakness. You know, the US has imposed travel restrictions from people from the UK. Australia has extended lockdowns. So, you know, the travel stocks have been particularly weak. You look at what the airlines did, and that would confirm that, you know, COVID is the source of concern right now. But, you know, you look at the UK, hospitalizations and deaths are still in check. They haven't gone nuts. And we still had our reopening day on the 19th of July, right? And that's being justified by the fact that, you know, we are seeing a lot of cases, but we're not seeing the follow through on deaths. So hopefully that remains the case. And then these fears can abate. And then we see a similar sort of story everywhere else, that even though cases are jumping, deaths aren't following to the same extent. And then this little wobble in the market can get digested, and we can kind of go back to some kind of normality, and we don't just get a complete reversal on the reopening trade, basically, right? That my base case is probably that. You know, I'm not jumping in with 2 feet to really put on loads of risk. I did do some opportunistic buy the dips with some tight stops yesterday on the S&P around that level, but until we get a 41 handle on the S&P, and I feel like we've had a real proper flush out, then I'll be more interested in adding more risk in a more meaningful way, right? So right now I'm not jumping in with 2 feet. Also, if we know what's been holding up this market, it's been the tech sector, right? So that's been the final pocket of strength, particularly in the large caps, and what's been holding up US indices relative to everything else. And we've got large cap tech earnings kicking off. Obviously got Netflix sort of today, but you've got Apple and Amazon and the like all coming in next week towards the end of the month. And, an interesting graphic that I saw was if you look at the tech sector and how that's rebounded on the lower bond yield story, there's now a widening gap between where tech stocks are and where EPS momentum is, right? So this gap here, basically leaves a lot of work to be done for earnings, right, to justify the pricing. So that's the idea. So whereas tech has been what's been holding us up, there's a fairly high hurdle for tech on this earnings season for it to continue rallying, basically, right? So that might be why we continue to kind of see headwinds and markets don't rebound just immediately like they have been doing, led by tech, like we saw in the last sell-off a couple of weeks back, basically. Yeah. So that's one side of the story. The other side of the story is cyclicals versus defensives, growth versus value. That has been rolling over for quite some time now, right? So there is an argument that, the market under the hood has kind of seen this coming, seen this rollover in growth, and now these stocks are pretty beaten up on a relative basis, okay? So, I mean, the thing I like to just kind of eyeball on that is Russell versus NASDAQ, just to see where that is. Let me share the screen on that. So the RSI down there on the 4 hours at 21. I mean, this thing has been battered. Now, and also you look at the correction in it as well, it's kind of quite, it's quite a measured move, right? If you look at that like an ABC correction, there's definitely room for a bit of a bounce in Russell versus NASDAQ, but the problem is the narrative isn't there, right? So the narrative support isn't there right now for this trade, but you could argue a lot is getting priced in, right? So PMIs and the growth data needs to really roll over to justify the beatdown in this spread, basically, right? So I would argue that if you're looking for a snapback here and we don't get growth numbers roll over and it stays relatively robust, then this thing's got a nice rally in it, basically, right? So value versus growth, Russell versus NASDAQ, not a bad place to kind of maybe dip your toes in when you think the weakness is kind of over. Yeah, I'm not saying jump in with 2 feet now, but definitely something to keep an eye on. Also, you look at fear indices and things like that, greed versus fear and stuff like that, pretty beaten up, right? At lows not really seen since March last year, right? So sentiment isn't super bullish. If you look at some of these fear and greed indicators and stuff like that, that the various banks put out and things like that. So, and that would suggest that when we do finally put in a low, people have put on hedges. We know that the skew index has been trading pretty high. So, buy side people are hedged. Maybe the retail guys have done a bit of crazy stuff selling puts, but buy side people have been relatively well hedged. And once the correction is played out, there's going to be some hedges that need to be unwound, and that could fuel a bit of a rip back higher, basically. Okay. I have been flagging SXTP in Europe, right, as a bit of a signal that the COVID story was going to get worse. That was a travel and leisure sector in Europe. And I was thinking, whilst that's rolling over, even Europe bouncing was a bit of a question mark, right? That was a bit of a suspect bounce in Europe. That led me to kind of want to lean more short DAX than anything else. I mean, it's hard to sell the S&P when tech stocks just can't sell off, right? So selling DAX, proved to be an all right trade. So it smashed through this sort of first support of 15.3. Next sort of obvious support looks to be 14.850. If we can head there, that's probably where I'd cover the balance of any DAX shorts that I'm running. I was running some opportunistic sort of shorts that I put on towards the end of last week. But that's kind of where we are in Europe. Obviously, the dollar move has been, a bit of a driver here of risk sentiment. But, you know, momentum in the dollar's not convincing me, right? So the dollar's pushing up towards this 93.5 resistance zone, but it's forming a bit of a wedge here in the short term, and momentum's waning on that rally. Right, so I suspect the first test of 93.5 is going to fail. What we then do after that remains to be seen. But if you're looking to play the dollar break, I'd probably wait for a break of 93.50, right? If we get that break, that's going to coincide with a euro breakdown of around 117. If euro breaks down 117, it already looks like it's kind of breaking a bit of a support here on this upward sloping, but I think 117 is a big area of horizontal support. If that breaks, that opens up room to 114 on the euro, and you'll be able to buy cheap optionality there, right? Euro vol ain't going away from 6 in a hurry, basically, right? So if we get the break at 117, you'll be able to buy some euro puts. They'll be on a 6 handle. They'll give you good leverage to that move down, basically. So I don't think you need to be in a massive rush to buy it. If you want to be opportunistic and load up on euro puts, they're always going to look cheap because that's what FX vol does. Yeah. But I think you're probably best off waiting for a confirmation of the break on that stuff. And on the dollar front, I mean, dollar's been grinding higher as positioning's been getting cleansed, right? So there definitely was a fair amount of short positioning in the dollar. Got this graphic here that kind of shows that positioning's been a bit squared here. So we got non-commercial leverage fund asset managers. You can see, you know, we're getting a bit closer to neutral on the dollar positioning here. You still got asset managers supposedly short a ton. That's where we are, right? So not clear whether dollar can break 93.5. If it does, I think it's going to cause a load more pain on the risk asset side. So quite important inflection levels here. And then commodities. Before I stop talking. So obviously COVID fears have been the big driver. So we had a massive move down in oil. Let me bring up the chart here. So where are we? WTI rolling over aggressively into pretty major supports, right? Between 65 and 66. Quite a lot of support. My horizontal lines are the Fibonacci confluence zones. We've also got an uptrend in place here. So, you know, pretty big support levels here, but COVID dependent in the short term, right? That's the thing. So fundamentals for oil, in theory, were pretty solid. You know, you had the reopening, you had travel coming back online, you had, you know, a bit of a reduction in supply, all those drivers. All of a sudden now COVID has put a big spanner in the works right now. Like I said, I don't think the COVID fears are going to persist that long. They might overshoot a bit in the short term, but I don't think they're going to persist that long. So I've started picking up some oil tactically. I bought a clip at 67.5. I'll probably use some of these other support zones to add. But I think over a 3 to 6 month horizon, I think we could see much higher levels in oil, right? So you've got to size yourself appropriately to be able to hold on to that risk, basically, I would say. Yeah. So yeah, because it's volatile, right? I mean, it can drop if it can drop 8% in a day, you know it's volatile, right? So you don't want tight stocks in oil, basically, right? Because they're pretty guaranteed to get hit. And then on the other commodities, I mean, gold's been an interesting one, lagging real yields massively, right? So, you know, gold's supposedly meant to track real yields. It's done a really bad job of that recently, right? As yields have rolled over, break-evens haven't kept pace with nominals. And you've got this chart here with the orange line showing real yields inverted. So it going higher means it's going more negative. And gold's kind of supposed to be tracking that. We've got quite a big gap forming between where gold is and where real yields are. Real yields are almost back to their most negative levels, right? Sort of negative 1.05-ish, okay? Now, the dollar strength is being blamed on why gold can't rally. Yeah, but I don't know. I mean, I think with the dollar momentum waning, there's definitely a risk here of a gold catch-up trade, even in the short term. I know I've been saying I like gold on a longer-term basis anyway. Even on a shorter-term basis, I think there's room for gold to have a bit of a catch-up here, especially if risk aversion comes back to the table, right? So you had well, we obviously got growth rolling over and what's going on in the bond market. You've got COVID concerns coming back, and you've got geopolitical tensions with China over like cyber attacks and stuff, right? So all these type of things generally tend to play quite well for the safe haven that is gold, right? So I think a tactical gold trade could make sense. The big hurdle on gold has been that sort of 1825, 1830 resistance area. If that breaks, then you've got some legs to run. And then according to this chart, you know, you've got room to catch up to maybe around 1950. Now, another way to play gold, which I've been using, has been the gold copper ratio. So I was kind of looking at that last week, and I was thinking to myself, well, if we're going to move, if we're in this kind of macro regime shift out of reflation, and the next shift, we don't know whether it's going to be deflation, where we've got growth rolling over and inflation rolling over, or whether inflation is going to remain quite sticky, but growth we are seeing rolling over as well. So then that's more stagflation. So it doesn't matter which one of those regimes you're in, stagflation or deflation, gold is going to outperform copper in those regimes, basically, right? So if you think the reflation regime is kind of played out, which it does smell like it has, then that is kind of a decent trade, looking at that relative spread. So I bring up this chart here. You know, I've kind of looked longer term. That gold copper ratio obviously had a massive run from last summer, went pretty much parabolic. But look at that formation. That looks pretty ugly, right? Like I mean, I'm not big on head and shoulders myself in terms of charting, but if you ever saw a head and shoulders, that was it, right? So, I mean, I just like the fundamental switch. I think, you know, I love copper longer term. I've been banging on about copper for a long time, but I also think copper easily tests 385 if this kind of reflation trade gets put to the test as it is. You know, I've got 385 as a confluence zone down here. Copper seemed to be contained by this short-term downtrend last week, where it's done it twice actually. So that kind of increases my conviction that this downtrend's in place, and that copper gold switch makes a lot of sense to me, right? So I did that trade last week, and I'm watching it. I might even add to that trade if my conviction kind of increases on that trade, right? But that, for me, that's kind of quite a good way to play commodities, where you don't take too much dollar exposure here because you've got one commodity against another, and you're kind of taking advantage of the relative cheapness of gold versus real yields. And you're looking at that copper downtrend, thinking it's probably got some room to play out. There's probably still some lazy positioning in copper because everyone loves it longer term. And there might be a bit of pain in the short term that needs to flush out some more lazy copper positioning. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. I'd also encourage you to sign up for a free trial to our live and interactive Macro Insight Zoom call. As part of our trading community, as well as the call, you'll also get access to our Telegram chat and our weekly market reports. To find out more, you can also connect with us on the socials. All the links are at our website, www.options-insight.com. Thanks.